please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
10,595. That's where the markets are starting, about 1.5% lower, both for the Sensex and the Nifty. Sensex is below 35,000, 34,500, 550 almost gone. And in the mid-caps, it's 2.5 lower, no, 2.6 lower, and about 530 points gone, both on the Nifty Bank as well, about 2% lower. Well, it's a sea of red. So biggest losers, UPL, it saw the pre-budget buying as an agri stock. So that bit is coming off. Vedanta, Hindalco, Bajaj Finance, Indiabulls Housing. Actually, it's a sea of red. I don't know if there's anything in the green. TCS, Infosys, Tata Motors, HCL Tech. Actually, the 5 tech stocks are showing minimal losses, down about 1/3%. Otherwise, just about everything is red. And stocks like Vakrangi continue to correct. It's about 10% lower. But Sonia, I'll leave you to read out some of the outstanding underperformers.
Oh, well, it's a big crack that you're seeing in the mid-caps, Lata. Almost 600 points gone, another 3% knocked off there. And the advanced decline ratio is now at 1:17 in favor of the declines. Of course, the usual suspects like Vakrangi continue to fall, so that's down 10%. Relcom, Adani Power, HCC, JP Power, all down about 5 to 8%, Syntex, etc. But this market is also punishing weak numbers. Inox Wind reported a very weak set of numbers this time, a huge EBITDA loss, and Inox Wind is now down almost about 10% on huge volumes as well. Apart from that, you have a couple of other weak earnings coming in from the likes of Union Bank, Gujarat Gas, etc. So just keep an eye out on those stocks as well. Even a lot of non-index, good quality large caps are falling now. Future Consumers is down almost about 6% or so. And, stocks like Jain Irrigation continue to fall down about 4%. So all in all, it's a weak start. The Sensex is now down another 450 odd points. Not looking too good.
Yeah, not looking too good. Some stocks are recovering though. PC Jeweler clearly is a case in point that's recovering. But I think the stock that's looking really interesting right now on the way down is Jain Irrigation, because it's out of the F&O ban, and that immediately down about 4.5% on that stock. So that's looking interesting. Actually, across the board market, we may have a bit of a margin problem between 9:30 to 11. After that, it will be interesting to see if there's intraday recovery as well. You normally see that play out, but as Udayan said, maybe the best approach right now is to just wait and watch. A couple of stocks like Just Dial right now down about 7%. Udayan, good morning. To be fair, this market had given warning signs even before budget. All through January, advanced decline was in favor of declines. We had seen mid-cap starting to underperform. Now, do you think we could go through a process of complete cleansing out? Is that possible? We haven't had that process in this current phase of bull market for last 2 years.
I think, Anuj, it is unlikely to happen in the large cap space, because large cap valuations, while not very, very compelling, are not completely out of whack. You're already seeing some defensive buying happening in the IT space. Generally, I think there will be a flight to quality. And what will happen is that there will be a compression in the PE multiples of many of the mid caps, which had gone up 2 or 3 times over the last 1 year. I think that's the big story of 2017. The amount PE multiples expanded for many of the mid-cap companies. So where there is a lot of cash flow and there is a lot of quality, you'll probably see the first fall, and then maybe PE multiples will not compress very significantly. But for a whole host of mid-caps and small caps, I think that is the real threat, that we'll see a major valuation compression. But I don't see that frankly happening in the large cap universe, because I think foreigners may still continue to buy on declines. Now, I'm not saying that the market will not fall or the Nifty will not fall, but after the big rally in January, I mean, let's take it the starting point not from 11,100, but let's take the starting from 10,500, which is where the year started. If we just take out this January rally, which is the pre-budget rally, from there, could the market correct another 5-6%, taking us back to 10,000 or sub 10,000 levels? That's entirely possible. But that's not a massive sell-off in the market, a 10% correction from the top, which is par for the course. It is, I think, the PE compression in mid-caps that you need to be very cognizant about. And the less quality you have, the sharper will be the PE compression now.
Okay. Well, I just wanted to highlight the difference between global markets, or maybe US markets and some emerging markets in India. We were underperforming already in the equities and seriously underperforming in the bond markets for some time now. Therefore, then do you think that, I mean, I was making earlier in the morning the distinction between demand pull inflation in the US, if any, and a cost push inflation in India, probably because of MSP and the fiscal deficit. So should we approach India a little more cautiously?
Well, we have to approach only India because most people who are watching your show don't invest anywhere else. So for us, it's an absolute call, everybody who's out here. So we look at only our market. But I think foreigners will make this distinction, Lata, the one that you're making. They will say this market was underperforming because of what was going on in the bond market there and what is going on with oil prices and very high valuations. Now with long-term capital gains tax coming in and the mood spoiled, mood is important for the PE multiple. And therefore, if the local or the domestic mood gets spoiled, then India has a very genuine chance of underperforming other global markets. We've already been doing it this year, and that underperformance might get even starker as time goes by. The only point which I'm trying to make is, we've seen 300-point falls 4 or 5 times last year. They were all bought into and the correction did not last a few days. I think it's important to distinguish that this time something bigger is happening globally and locally, and you need to be cognizant of that. This is not just a technical trading call. We are down 300, buy it quickly, the next week we'll be going back to 11,200 again. I think something fundamental has changed in the taxation structure with interest rates and with the global outlook. So we'll just have to wait and see how this plays out. I'm not suggesting for a minute that this is a major trend change for the market, but you can certainly go through a phase of maybe 3 or 4 months where the market struggles and you get a lot of opportunities to buy stocks. So don't be in a hurry that if I don't buy today, by Wednesday stocks would have gone back to where they were trading 1 week back. Okay. That is most unlikely to happen.
By the way, just look at PC Jewelers and clearly, you know, it looks like, you know, someone just bought it big time, 25% higher right now on PC Jewelers. So obviously there's buying as well.
Oh, yes, there is. By the way, the market also has recovered about 50 points from the lows. The low on the Nifty was 10,586 and now we're back at 10,620. Udin, just to wrap up that conversation about what the approach should be now, given what we've seen from the budget and the fact that equities across the globe has lost a bit of its luster over the last month or so, do you think it's time to rebalance your portfolio, maybe shift some money out of equities and into debt in the near term?
Some people would do that because yields have hardened quite a bit. You know, I think the better approach to do is to sit on cash right now and to use this quarter between now and say 31st March or 1st April to see what kind of prices you get. Because, you know, that's the problem with a lot of investors, that when the going is good, they can't get enough of stocks. And when the going is bad, they say now we'll rebalance and then we'll move away from equities. You know, nothing will happen if the market does not perform for 6 months, because you would just be getting stocks without their valuation froth. This is not a call to buy today, but over the next 3 to 6 months, who knows, maybe you get the kind of prices that you could not have imagined that you would have got even a month back. And that, I think, is a time to go overweight on equities, to buy more stocks, and to wait out this dark period, however long it lasts, because I think next year onwards, we will probably be making more money in equities. Just one quick point I want to make. You know, we have been talking about many risks about this bond market and oil prices and budget, etc. I read a CLSA note today which was quite disturbing, and they're one of the most bullish brokerages on the street. They said that 46% of stocks they downgraded after this quarter's earnings, and they upgraded only 23%. So that flies in the face of the rah-rah optimism that we are hearing from a lot of people about how earnings can only go one way, which is up. I think there are notes of disappointment in earnings also this quarter.
Okay, that's an important caution you're putting on the table. Thank you very much, Udayan, for joining us this morning. We'll thank Sudarshan and Mitesh as well. We'll, of course, get back to them a little later in the morning. It's time to invite our market master for the morning. Bharat Iyer, Head of India Equity Research at JP Morgan, joins us in the studio. Morning, Bharat. Always a pleasure having you, and doubly important because you're coming at a crucial moment. Would you agree with what Udayan was telling us towards the end of the conversation, that the earnings picture is not that bright as we thought on first glance?
Well, Lata, I would agree with that in the sense that I think street expectations are still frothy. If you see FY18 now, I think the street is still expecting 14-15% earnings growth. For the first half, we were flat. and which means that the run rate expected of the second half is more than 25 to 30%. Good that the third quarter reporting season has been so far. I don't think we're going to do 25 to 30% in the second quarter, or in the third quarter or the fourth quarter. And likewise for next year, I think the street is at 20 to 23%. I think 14-15% seems more like par for the course rather than 20 to 23%.
Yeah. And this year, what would your number be?
This year, I think we'll be happy if we get 8 to 10%.
Okay.
Okay. Bharat, good morning. Of course, so a lot of this is global in nature. Are you sensing first signs of trouble in the paradise, I mean the equity paradise?
I think, Anuj, what's happening is that markets are beginning to price in a higher cost of capital. And this is the beginning. I think we still have a long way to go. But yes, I mean, these are the first early signs.
That would be a big negative for the broader market because, we have seen a big part of this rally was interest rate driven rally as well.
You're right, Anuj, in the sense that, see, I don't think this is the end of the bull market. Yeah. But I think what's happening is that we are getting into the mature phase of the bull market. And that means that, we'll have a lot of volatility which comes in. And I guess, the other takeaway that at least I, make out of this is that valuations have perhaps peaked. So, I think earnings growth will have to do the tough job from here onwards.
But as a global market watcher, don't bull markets hinge on growth? And we're getting good growth, right? I mean, Chinese PMI has improved. Even in the US, we've seen wage growth pick up after so long. Isn't that a positive sign? And don't you think that would be the next leg of the bull market?
It is positive, Sonia, which is the reason, as I said, I don't think this is the end of the bull market. But, for the last 6 months, we had this Goldilocks syndrome where the markets were being driven by two engines. Valuations because of easy monetary policy on one hand and a pickup in growth. I guess one engine now starts tailing off a bit because of the higher cost of capital, investors starting to impute a higher cost of capital. So the tough work will have to be done by earnings. It does not mean markets have peaked. But yes, I mean, one engine will have to work hard now.
No, is the rise in the cost of capital higher than you anticipated? And therefore, would you want to trim your earnings expectations for this year or the next?
I think earnings expectations globally, if you ask me, are okay. Because we've had this trajectory where, earnings have been picking up and economic growth, if any, has been surprising and has have corporate earnings. But on the cost of capital front, yes, I think, markets are getting a little jolted out of complacency. Because if you see, I mean, if I look at our own house view, we were expecting 4 rate hikes this year by the US Fed, whereas the market for a long time was perhaps pricing in only 2. And I guess, we're seeing a little bit of a shift there in that paradigm.
Yeah.
Okay, by the way, there's some bit of recovery in the market and not entirely unexpected. 10,550 was supposed to be a big support. IT is starting to do well, and not just large cap IT, mid cap IT. Take a look at a stock like NIIT Tech, for example. That's the one where at least there's some semblance of buying. That's the Nifty IT, which is about up 1/3 of 1%. But overall, there's still clearly pain in the market. 1:19 advanced decline is what we have. Could this be a bit of a safe haven for now?
I would think so. Near term, it's not a bad space to be in because, on the one hand, you perhaps have the rupee depreciating a bit, which is always good from a sentiment point of view. You had meaningful supply taken out of this sector in the last 3 or 4 months because most of the large caps have done buybacks. And, the global growth environment is still okay. So I don't think we should get very carried away on the growth front. Yeah. But that said, in terms of the relative underperformance we saw last year, perhaps a little bit of mean reversion.
Is this a buying opportunity for long-term investors? And if yes, what are the pockets that you will be looking at? Maybe not now, but over the next few weeks.
I think, as I said, I don't think the bull market's ended yet. So I'd look at this as a bull market correction. Okay. And in that sense, yes, I think, it is a buying opportunity. I think, 2 or 3 pockets look very interesting. I think, if you look at financials with a very solid liability franchise, if they tend to get sold off in this sell down, I think, that's an interesting place to look at, particularly if they have a very good financial services franchise. Segments that, cater to the government's core infrastructure priorities, areas like cement, tractors, construction equipment, select capital goods companies, I think they should all do well. I think the budget was reasonably good to these sectors in terms of outlays. And I think, a theme like urban consumption still has a long way to play out in India. You have the demographic advantage, you have so many people still living in villages, and agriculture is clearly not doing too much, so they have to keep moving in. So I think the long-term themes are still good, but yes, you have to be a little cognizant of valuations given what's happening to the cost of capital.
Okay, would you be more global facing than domestic facing?
Near term, I think, again, within global facing, Lata, will have to, make a little bit of a distinction, because what could happen is, if this cost of capital paradigm keeps going on and you see the dollar bouncing back meaningfully, that could mean bad news for the resources complex. So let's see how it pans out. I mean, it's still very early days. So one will perhaps have to be a little selective in terms of what one does.
Okay. What is your take on the budget itself? Is there a worry that fiscal deficit is more than you all anticipated, or the MSP issue could lead to more CPI inflation, and therefore, what's the take on the domestic cost of capital?
See, I think, we had a fairly pragmatic budget. I think, I quite, like the assumptions in terms of nominal GDP growth, in terms of the expenditure part, the fact that consolidation was being driven more by cutting down on revenue expenditure rather than capital expenditure. I think, but like many other people, what we do worry about is the tax collections budgeted on the GST front. And honestly, I don't understand too much of it. So it's something which remains a bit of a black box. So we'll have to see what happens. And added to this is the worry on oil. So I guess, but to be fair, I mean, it's not just the budget, right? I mean, the bond markets have been pricing in these stresses for some time now, nearly 6 months. And I guess, they've priced it in fairly at this point in time. So, I don't see any hiccups from these levels. But that said, is the higher cost of capital a worry? It definitely is.
Okay, you spoke about some of these domestic segments like cement, tractors, etc. What about, more rural-focused spaces like two-wheelers, for example? Is that a space you like? Because we're seeing a lot of big moves in names like Bajaj Auto, etc.
I think that's a space where, we're neutralish at this point in time, basically because of two reasons. One is, valuations have really surged in that space. And the other issue is, this is a segment that has reasonable penetration levels. So, it's good for an 8 to 10% kind of volume growth. And, if that's well priced in, well and good, otherwise, you don't really want to chase those stocks at these levels.
Okay. We almost forgotten to ask you, is long-term capital gains negative at all? Your take would...
Well, I'll answer that question in two parts, really. I think, first and foremost, is it negative for an investor? It definitely is. Let's not forget that, till yesterday, if I made 100, or day before yesterday, if I made 100 rupees in gains, I walked away with 100 rupees. Today, I walk away with 90 rupees. So, do the markets have to derate? Everything else being the same? Yes, I think they should. But that said, I mean, from a policy perspective, do I look at it as a negative? Not necessarily. For 2 or 3 reasons. One is, if you look at it, most countries in the world, whether it be in the developed markets or be it in terms of emerging markets, do have long-term capital gains tax, and most of them in the 15 to 20% range. So we're still better off. That's one issue. The second issue is, we perhaps had this very liberal structure at a point in time when we needed to encourage money coming into equities. The foreigners saw India more as a cyclical market than a structural market. Local savings were not coming in. Now that has changed. I mean, foreigners see us more as a structural bet rather than as a cyclical bet, and domestic savings is coming in. And to be fair to the government, I think they let us know about their ideological stance as early as December 2015. So, I mean, we can't complain.
Okay. And just on the issue that, again, we discussed with Udayan, and you probably heard, the cost of capital is higher and there is a tax on equities. Will you see this domestic liquidity that you spoke about flowing into equities getting disturbed now and more going to debt?
Partially disturbed over the near term for 2 reasons. One is, let's face it, the relative attraction of debt versus equity has improved meaningfully in the last 6 months. One, with yields going up. And secondly, we've had this change in taxation. But that said, Lata, if you ask me, this surge in domestic liquidity into equity markets that we've been seeing over the last 3 years, I think has 2 components to it. There is a structural component to it as reflected in money coming in through SIPs or the provident funds investing, etc., which still I think has a long way to go. And there was the cyclical component, real estate not looking good, gold not looking great, done with rate cuts by the RBI, so it thought equity was the best part. I think the latter part has a chance of swinging the other way. The former part, the structural part, I think still continues.
Okay. All right. Bharat, thank you for stopping by and speaking with us. And have a great week.
Just squeeze in one more. What do you think is, I mean, how much bad can it get for the Nifty? What are your own in-house technical experts telling you?
Well, I mean, we don't...
Or even what's your own guess? I mean, are we like kind of already in buy zone?
I guess in this correction, Lata, I think the Nifty bottoms out somewhere between 10,000 and 10,300. I still think that, the next month or so could be a fair bit challenging, both for global and local reasons. But I think in this round, I think that's perhaps a good bottom to start with. And yeah, we'll see.
Okay, and that's of course also the technically important, and we've seen support clearly. 10,550 was where on the way up there was some trouble, and on the way down clearly acting as big support. Thanks a lot, Bharat, for joining us. Couple of stocks have already started to recover. Just see the intraday chart of Raymond. That stock, of course, is seeing quite a bit of recovery from the lower levels. In fact, there was quite a bit of selling in a lot of mid caps, and that's now recovering. One advanced decline, which was at about 1:27, has already improved to about 1:15. So 9:30 to 1:11 would be key period to watch. But stocks like Raymond and Gen Irrigation are already quite a way off the low point of the day.
Okay, fair point there. So let's see what happens through the course of the day. It promises to be a very volatile day, if nothing else. But let's talk about some earnings now. Cummins posted a weak set of earnings in Q3. Poor exports and lower margins impacted the results. But I think the biggest takeaway for me was the fact that the company has reduced their domestic market growth guidance to 0 to 5%, as against 5 to 10% earlier. Rajiv Batra, the CFO of Cummins India, joins us on the phone line. Rajiv, hi, good morning. Earlier we would always talk to you about exports being a pain point, but now you've lowered your domestic guidance as well. Are you seeing a lot of pressure in the domestic markets? And if yes, how long do you think this pressure could last?
What we are seeing is that the investment cycle, especially on the capital side, on the power gen markets, that has yet not restored. So it's taking longer than we thought it would. So, which is why we thought it was prudent, and as we told you last time as well, when we come to this quarter, we'll let you know what the outlook is. So, I would believe the power gen revival, corresponding to investments being again made in the economy, is about 2, maybe 3 quarters away.
Okay.
2, maybe 3
I can understand you not expecting further sales, but you have actually downgraded, which means you see lower revenues than you saw in the previous year.
Flattish. We are doing very well on the industrial markets.
Okay.
On the industrial markets, what we are seeing, in fact, is a sequential recovery of about 23 percentage points, taking our revenues coming in from certain sectors which are doing very well, like the rail market. That has substantially gone up, the mining market, the construction market. So the industrial markets where you're finding tailwind from government investments, and our own efforts are taking more share from that market, that's doing very well.
Okay.
And we are looking at least compared to last year, a 15 to 20% growth in those markets.
Okay.
Power gen market really impacted because real estate is hugely down. And the infrastructure investments of creating more capital in that segment is just not happening.
Okay. Mr. Batra, good morning. You said power gen is 2, maybe even 3 quarters away from recovery? Just to confirm that point.
Yeah, that's exactly what we're saying.
Okay, so in that, how will it impact your overall guidance then going forward?
What we're looking at, like we said this time, we are looking at flat to 5% on domestic, which is down from the 5 to 10%. So we're in the range of 0 to 5. The following year, we will come back. And at this point in time, we're looking at between 5 to 10%.
What is the share of power gen and non-power gen?
Power gen is roughly in this quarter about 300 crores out of our 900 crores.
Okay.
Okay. When you
about a third.
Sure. When you say that the investment cycle has not been restored, is it for the sector as a whole, or are you seeing a lot of competition which is perhaps impacting your business as well? And I also wanted to understand what the impact of GST has been on the overall investment cycle.
Yeah, I think share-wise, we are very comfortable.
Okay.
We have a very dominant share in the power gen market, especially in the high horsepower segments. That is maintained, in fact, slightly growing.
Okay.
So share-wise, despite the price aggression, we seem to be doing very well.
Okay. Mr. Batra.
Now on GST,
Yeah.
Go ahead.
GST in this segment has not seen much of an impact because all of this is organized sales. So those sectors have not been impacted by GST. What was impacted for us last quarter was our sales and service revenues, where our customer systems were not ready. And that has seen a very sharp recovery this quarter, with a 46% sequential recovery over the previous quarter, where the GST, the problems that we saw with our customers, they have been dealt with.
Okay. Mr. Batra, final question. You had denied rumors of Cummins buying Kirloskar units. Any update at all? Will you all rethink?
Our stand remains the same, which says that at this point in time, we have not engaged in plans to look at that investment.
All right. We'll leave it at that. Mr. Batra, pleasure speaking with you. Thank you very much for joining us with the fine print of your results.
Sharp recovery in the market, actually, in the context of where we are, because if you look at the Bank Nifty as well, and even the Midcap index, on the Nifty, for example, let's just pull out the intraday chart of the Nifty. And the low was 10,586. We are at 10,639 now. So from the low point, there's been about a 55-point recovery, about 0.5%. 11,000 on the way up was very easy. So easy on the way down as well. 10,500 to 550 took so much time for the market. You had to build so much base around that. So that's why that's a much bigger support for the market, and also a much more important moving average as well. So that's why there would be one attempt to at least hold 10,550 is my sense.